LIBOR stood for the London Interbank Offered Rate. It wasn't a stock. It wasn't a bond. It wasn't a government decision. It was the price of money. Every single day, major banks names like Barclays, JP Morgan, Deutsche Bank, UBS, and Citigroup were asked a simple question. If you had to borrow money from another big bank today, what interest rate would you pay? Each bank sent in a number. The highest and lowest were removed. The rest were averaged. That average became LIBOR. On paper, it looked clean, efficient, elegant. In reality, it was dangerously naive. Because those numbers weren't based on real transactions. They were based on trust, the assumption that trillion-dollar institutions would tell the truth. And in high finance, trust is the easiest thing to weaponize. LIBOR wasn't just important to banks. It affected everything. More than $350 trillion in financial contracts worldwide were tied to it. Mortgages, student loans, credit cards, corporate debt, government borrowing. Every time you paid interest, LIBOR was there in the background, quietly deciding the cost. Economists called it the most important number in the world. And yet, it was built on banks guessing what borrowing might cost. It was like letting students grade their own exams and then paying them bonuses based on the results. At first, the system appeared stable. Markets functioned. Nothing exploded. But inside the banks, a realization slowly spread. If a tiny movement in this rate could shift trillions of dollars, then influencing that number meant power. Invisible power. And power in finance is never left unused. Here's how it worked. Imagine 16 banks submitting their daily rates. A few numbers are thrown out. The rest are averaged. Now imagine a trader holding a massive derivative position, a bet that pays off if interest rates move slightly up or down. If LIBOR drops just a fraction, that trader makes millions. So instead of waiting, he sends a message to a colleague on the desk that submits the rate. Can you nudge it a bit lower today? The colleague adjusts the number. Barely noticeable. But when trillions of dollars depend on that average, even 1/100% moves billions instantly. The trades pay off. The profits roll in. It wasn't complex. It was subtle. And that's why it worked. No one was watching. The British Bankers Association assumed banks would be honest. Regulators trusted the system. For years, everything looked fine. Until it wasn't. By the early 2000s, quiet manipulation turned into open coordination. Traders across continents chatted in private rooms with names like the cartel and the mafia. Their messages were casual, almost childish. Can you push 3-month LIBOR down a tick? Sure, mate. You owe me a bottle. I'll return the favor tomorrow. They joked about fixing the fix. Champagne was sent. Tickets were exchanged. Meanwhile, pensions, mortgages, and national budgets were being quietly affected. This wasn't rogue behavior. It was routine. And that's what made it dangerous. When the housing market began cracking in 2007, LIBOR became pure fiction. Banks no longer trusted each other enough to lend, but they didn't want to show weakness. So they reported artificially low rates. The interbank market had frozen, but the numbers pretended everything was fine. One economist later said, LIBOR was the thermometer, reading 98 degrees, while the patient was in cardiac arrest. Banks lied to protect themselves. Regulators looked away to avoid panic. The world kept using a number that had lost all connection to reality. The index designed to measure trust became a symbol of deception. The truth finally emerged in 2012. Whistleblowers, journalists, and investigators exposed the scale of the manipulation. Barclays admitted wrongdoing and handed over chat transcripts. What shocked people wasn't just what the messages revealed, but how normal it all sounded. "We all did it," one employee said. And he was right. UBS, Deutsche Bank, JP Morgan, Citigroup, Royal Bank of Scotland, all implicated. This wasn't a bad Apple problem. It was a system designed to cheat. Fines totaled around $9 billion. That sounds large until you realize how much money the manipulation generated. Even tiny LIBOR movements shifted billions. The fines were just a cost of doing business. A few traders went to jail. Executives resigned. Bonuses continued. Markets barely reacted. Most people never fully understood what happened. And that was part of the protection. When a crime is too complex to explain, accountability dissolves. LIBOR wasn't broken because of bad math. It failed because it relied on honesty in a system driven by incentives. Traders didn't need to hack anything. They were the system. They understood that markets don't move on morality. They move on profit. The more the world relied on LIBOR, the more valuable its distortion became. By 2023, LIBOR was officially retired. Its replacement, SOFR, is based on real transactions and better data. In theory, it's safer. In practice, it still depends on the same institutions, the same incentives, and the same culture. Because the LIBOR scandal was never really about interest rates. It was about trust. Trust that quietly underpins every financial contract, every pension, every loan. Trust that doesn't collapse loudly, but slowly. Through emails, spreadsheets, and decimals no one questions. Money isn't just numbers. It's a story. A story about who decides, who benefits, and who believes. LIBOR didn't fall because the system was fixed. It fell because the illusion became visible. And maybe the most unsettling truth is this: the manipulation didn't end. It evolved. New names, new benchmarks, same logic. History doesn't repeat. It recycles. And as long as trust itself can be traded, the story will continue. If this gave you a new perspective, stay with the channel. History has the answers.